It's Brian Preston, the Money Guy.
Let's move on to Luke out on YouTube. He has a question. He says, should I pay more towards student loans with the high interest rate account of 5.1% or my mortgage of 5.75%? They're very close. I think you frustrated Bo.
Well, I mean, I'm not surprised. I mean, mortgage rates have been going way up. I mean, I think we've been spoiled. And I've shared with people, my first house purchase, my mortgage rate was 6.75, and I felt like I stole it. Because we just come through a period. My wife and I were talking about this the other night. Is that because what a nerdy conversation, But we were talking about
our old mortgage rates.
No, she was because we were just talking about the current world and what's going on. And she's like, "Do you remember the rates were like 8% when we were buying that first house?" And I was like, "Yeah, that's why we felt like we stole it when we got 6 3/4." So to hear you grumble at 5 3/4. I mean, I get it, but it's so interesting because, and Luke, I don't know, did Luke give his age? Is he in his 20s, 30s?
He did not say.
He still has student loans, though.
Right.
So, I mean, because we've shared when we go into, and this is giving you a peek behind the curtain on learn.moneyguy.com, when we talk about the financial order of operations, when we talk about step 3, which is high interest debt versus step 9, which is low interest debt, we try to give you an age breakdown on this because there's risk-free return, there's inflation, there's all kind of your age, there's all kind of things that go into this to where actually over time that the difference between low interest versus high interest is different for a 20-year-old versus a 60-year-old. And a lot of that's because when you're in your 20s, there's a much greater risk that you're not saving and building wealth and taking advantage of the time component versus when you're in your 50s and 60s, there's a much greater risk that you're not keeping your wealth by taking too much, by leveraging and having debt. So that's why there's a huge difference in that. So, so I would say somebody who's in their 20s, a 5.1 student loan and a 5.75 mortgage, they still don't classify as super high interest debt. And I know that sounds crazy in historical terms because we just came through a period where people were getting 2.5% on their mortgages. So hearing 5% greater is better, but it's not until we get into 6 and 7% mortgages that I think they start falling into that high interest for 20-somethings.
Okay, we answered this question a number of weeks ago, and I said a thing, and you interpreted it me as suggesting that senility sets in early on, and that's not what I was suggesting. So I've really thought about how I could frame this different. And again, Brian, this is one of those things I love with Ruby asking the question because she gets to ask stuff that I kind of can think about, and then I'm going to say something, but you can completely disagree with me, and I think that's okay if you do. Not all debt is created equal. Not all debt is the same type of debt, right? So when you think about credit card consumer debt, that is different than student loan debt, and student loan debt is different than like primary mortgage debt, and primary mortgage debt is different than like investment debt, whether it be buying a business or buying a rental property. So you could have the same types of, you could have all the different types of debt at the same interest rate, but depending on the type of debt, sometimes it may qualify as high interest and sometimes it may qualify as low interest depending on the type of debt. For example, if you have a credit card that has a 3% interest rate on it, would you carry a balance on it? No, right?
It's a teaser rate.
Right, it's a teaser rate. It's not going to stick. It's not. And what you're doing is your future self is paying for something your past self did, right? You've already kind of gleaned the benefit from the consumption that you had. That's different when you have like a mortgage or a business or a real estate investment or something like that. That's actually an appreciating asset. It changes the dynamic. So when I hear you asking, okay, should I prioritize paying off a student loan at 5.1 or a mortgage at 5.75? I think your answer was great. You got to go look at, okay, what age am I? Where's my strata for paying off student loan debt? Have I done that? And then where am I in the financial order of operations? Am I at the point where it makes sense to start prepaying that mortgage rate? Because we don't know his income. Once you take into account the deductibility of mortgage interest, maybe 5.75 is actually some amount less than that because of the tax benefit. So I don't think you can just blanket look at the rate and make an assessment based on rate alone. Not saying anything there you disagree with.
No, I do love the purpose because, I mean, we had somebody just previously ask about what if they get a car loan at 2 or 3%. Does that still mean you should play it off in 3 years? And I'm like, yeah, because it's depreciating asset. I think the underlying what you're buying and what the debt's connected to does have a part of the decision-making process. And look, this is going to become a much more nuanced thing as interest rates continue to go up. And that's why it is so important, though, that you also create and respect that automated wealth building process. That's why I love people, setting up their employer-sponsored plan, because that's where we know millionaires are created, the Roth IRAs. Follow the financial order of operations, and you will navigate this well.
Love it.